All right, let's talk about 2026. What does the year really have in store for the US economy? Well, instead of guessing or using a crystal ball, we're going to do something better. We're diving into the actual roadmaps from some of the sharpest minds in finance to see what's coming down the pike. So let's get right into it.
So, here's the big question on everyone's mind. What should we actually expect? Is 2026 going to be a year of solid growth? Are we heading for stagnation? Or something else entirely? We're going to break down what the experts at places like Goldman Sachs and JP Morgan are saying, what they're debating, and most importantly, what it all means for you.
Okay, here's how we're going to tackle this. We'll start with the big picture numbers. Then we'll dig into three powerful forces that are shaping everything. After that, we'll zoom in on the Federal Reserve, scout out where the opportunities might be, and wrap it all up with a clear financial playbook for the year ahead.
First up, the big picture. Let's just cut through all the noise and look at the hard numbers that all these forecasts are built on for 2026.
Goldman Sachs is kicking things off with a pretty optimistic number. They're projecting the U.S. economy is going to grow by a solid 2.6%. Now, that's a big deal because it's actually higher than what a lot of other economists are predicting. They think things like less pressure from tariffs and just easier financial conditions are really going to help fuel that growth.
Now, for the number that hits your wallet every single day, inflation. JP Morgan is forecasting that U.S. inflation is going to land around 2.5%. The key takeaway here is that even though inflation has cooled off a bit, the experts think it's going to stay a little above the Federal Reserve's 2% target. It seems like slightly higher prices are just part of the new economic reality. And what this table makes crystal clear is that while everybody agrees on the direction that we're growing, nobody really agrees on the speed. You've got Goldman Sachs on the high end at 2.6%, you have Crow Holdings in the middle seeing a solid 2 to 2.3%, and then JP Morgan being a bit more cautious at 1.8%. So the main story is that the economy is expected to expand. This isn't a tale of a boom or a bust.
So we've seen the what, and now it's time to explore the why. What are the powerful trends that are actually running the engine of the 2026 economy?
JP Morgan points to three massive forces that are literally reshaping the market as we know it. First, you've got the AI revolution, which is just getting started. Second, there's this global shift towards what's called economic nationalism and reshoring. And third, that sticky, slightly higher inflation we were just talking about. These aren't just buzzwords, believe me. They are the fundamental drivers of this new economy.
You know, the conviction in this statement from JP Morgan is just really striking. They're not just saying AI is important. They're basically calling it a non-negotiable for anyone who's investing. The message couldn't be clearer. AI is going to shake up entire industries, it's going to create huge opportunities, and ignoring it, well, that's the biggest risk of all.
That second major force is this idea of reshoring. It sounds technical, but it's really simple. It's just the exact opposite of offshoring. You know, for decades, we saw companies move their manufacturing overseas to cut costs. Now, because of this new focus on economic nationalism and making sure supply chains are secure, they're bringing those operations back home.
And this isn't just happening by chance. According to analysis from the Bank of Texas, this whole trend is being pushed along by some very deliberate government policies. We're talking new tax breaks, tariffs on certain imported goods to make U.S. products more competitive, and even direct government money flowing into industries that are considered vital for national security, like semiconductors and medicine.
And the third force is that persistent inflation. The general consensus among the experts is that we are not going back to that world of ultra-low inflation that we knew before 2020. Things like reshoring, which can be more expensive, and really tight labor markets mean inflation is probably going to settle at a level that's not only higher, but also more volatile. This is the new normal we all need to get used to.
This brings us to the folks in the captain's chair, the U.S. Federal Reserve. It's their job to navigate this environment of steady growth and sticky inflation. And what they do next is the subject of some really intense debate. So before we dive into that debate, just a quick refresher. The federal funds rate is the main tool the Fed uses. The easiest way to think about it is as the master switch for interest rates. It influences everything from mortgages and car loans to what you pay on your credit card. When the Fed flips this switch, the whole economy feels it.
And here's where it gets really interesting. You have this stark disagreement between two of the biggest names in finance. On one side, JP Morgan's research team thinks the Fed is just going to stay on the sidelines and hold rates steady all year. In the other corner, you have Goldman Sachs, and they're forecasting 2 rate cuts. This disagreement right here is probably the biggest source of uncertainty for the markets in 2026.
Yeah, JP Morgan is very clear about their thinking here. They're basically saying, look, inflation is still above target and the economy is holding up, so why would the Fed rush to cut rates?
In fact, their forecast even suggests that the next move, whenever it finally comes, is more likely to be a rate hike in 2027 than a cut in 2026. A totally different view of the world.
Okay, so with this backdrop of steady growth, sticky inflation, and a whole lot of uncertainty about the Fed, where are the real opportunities? Let's dig into where the experts are pointing.
So here are JP Morgan's long-term annual return forecasts. And what immediately jumps out is just the sheer breadth of opportunity they see. They've got U.S. real estate leading the pack with an expected return of 8.2%, followed really closely by stocks, both global and U.S. And even bonds are expected to deliver a solid 4.6%, which is significantly better than just holding cash.
This chart really drives the point home. It highlights the potential cost of just playing it safe and staying on the sidelines. According to these forecasts, equities are expected to give you more than double the return you'd get from cash. So while, cash might feel safe, the data suggests that it could mean leaving a lot of potential growth on the table in 2026.
But, and this is a big but, we need to add some important nuance here, especially for that top-performing real estate category. Analysis from Crow Holdings points out that this market is split in two. Not all real estate is the same. They see sectors like retail as being really attractive, but they warn that office space is still struggling, so the opportunities are very specific.
So let's bring it all together. We've gone through the forecasts, the big driving forces, the Fed's dilemma, and where the opportunities might lie. Now for the bottom line, your financial playbook for 2026.
Okay, if you remember nothing else from our time together, remember these 5 things. 1. Expect steady growth, not spectacular, but steady. 2. Get ready for inflation to stay sticky. 3. Recognize that huge trends like AI and reshoring are creating brand new frontiers for investment. 4. Know that the debate over what the Fed does next could mean more volatility. And finally, number 5, diversification is absolutely key because opportunities exist across a whole range of different assets.
And that really leads us to our final question. The expert roadmap for 2026 shows a path that's filled with both promise and pressure. It's a year where we have steady growth, but it's clashing with persistent inflation and massive technological shifts. So the key question isn't what the experts will do. It's, with all this information, how will you navigate what comes next?